Ladies and gentlemen, if you've been following the channel for a while, for any length of time, you already knew that this would happen. We just did not know exactly when. Well, now we have a date. They told us that this would happen on the Friday, and well, the prediction came true this Friday. Today, folks, today is Friday, and this video could very well be the most crucial financial message of the year because a financial disaster very similar to 2008 is looming, and it has already begun. The proof is in Silicon Valley Bank, which is currently struggling to give customer access to their very own money due to a bank run. Now, we have been preparing for this, and we are now seeing this. People are frantically trying to withdraw their funds from small banks, and you might want to consider doing this too if you want to protect your capital. Now, for the best way to invest in gold, I'll leave a link for you guys in the description down below. Now, I'm not trying to cause panic or incite fear or anything like that, but I am warning you guys that something ominous is happening behind the scenes, and they're not going to tell you exactly what's happening, okay? I'm just being very clear and blunt about this. They're not going to tell the public exactly what's happening behind the scenes. Now, this has a lot to do with what Fed Chair Jerome Powell and the Federal Reserve is doing and this global monetary system, and more, even well beyond that. But I want you guys to know that, even panicked investors like Bill Ackman are begging the government to rescue the banks that are refusing to allow customers to withdraw their money. And the situation is alarming because these banks have already recklessly squandered our funds. Silicon Valley Bank plummeted 45% in just one day. And although the stock is suspended now, it is projected to fall another 50% by the end of the day. Now, despite the reassurances of people like Jim Cramer, for example, it's very clear that everything is not fine at Silicon Valley Bank. And of course, if you're new to the channel, please take a second, drop a like for the video. I totally appreciate that. It really helps to get this information out to more people who need to hear about this information. And for more news and updates related to money, the housing market, stock market, cryptocurrencies, make sure to subscribe to the channel. I really appreciate that, you guys. It definitely helps out. It definitely helps out with the support. Now, there has been a major development in the banking world. The FDIC has just reported that California regulators have shut down Silicon Valley Bank, a big lender which is located in California, after reporting a loss of over $1 billion from a single bank. Now, there were fears of a run on this bank, a bank run with people wondering if they should have, PTSD from 2008. Now, this is really an earthquake, guys, and especially for the tech community. Silicon Valley Bank dropped by 60% yesterday alone. And we just learned today that California regulators have shut the lender down. The bank has been shut down. And we've been warning about this for I don't even know how long. And many people have said, Ron, you're overhyping things. You're a fear monger, blah, 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 blah. Okay, now what? Right? Now what? I'm not making this stuff up, people. Okay. Now, this is one of the biggest failures since 2008, and actually the second biggest failure since Washington Mutual. If you guys remember that bank. Yeah. And if you don't remember that bank, it's because that bank is gone now. All right. So Washington Mutual back in September of 2008, this is a major lender for tech startups. Now, the FDIC says that insured deposits will have full access to immediate deposits on Monday morning, which means up to $250,000. Now, that's good news if you had less than $250,000 in the bank. Now, of course, we know that, some people, some small businesses, some startups, individuals may have well over $250,000 in the bank. And it is not clear at this time if they will get all of their money back. This is a huge problem, okay? And this is, yes, it is one bank, but I want you guys to understand that when people get concerned and, as this news continues to to be spread, this could potentially have some degree of a contagion effect and cascade on to affect other banks. Now, this, of course, is not sitting well with the marketplace. Now we see the Dow Jones down by several hundred points today, with banks leading the way a little bit lower, or I should say a lot a bit lower. Now, the good news here is that experts are hopeful that this is an isolated incident and this is not part of a broader systemic issue. But again, if we do really have a systemic issue, and this is already known to be a systemic issue, you and I will be the last to know about this. So I think it behooves us to not sit and wait to find out if there's a systemic problem. We should be taking action to protect ourselves, to protect our families. Have some cash on hand, alternative investments, alternative forms of currency. I'm just saying. I've left some helpful links in the description down below for you guys. Now, Mark Zandi, the chief economist at Moody's Analytics, says that he doesn't believe that this failure is indicative of a broader problem in the banking industry. Now, for the sake of everyone, especially all, my subscribers and, all my new people out here, let's just hope that he's right, because the last thing that we need right now is a systemic issue, right? Now, this major bank claims that, they're well capitalized, which is good news. Of course, that remains to be seen. Now, the Silicon Bank and the FDIC, really the FDIC is now in control. And we saw some stumbling from Wells Fargo, JP Morgan Chase, and Bank of America, with other banks trading, being halted yesterday in the middle of the trading day. Okay. So what does this mean for people outside of Silicon Valley Bank universe? I mean, does this mean anything for the average borrower? These are legitimate questions that people have. But the big question is, again, one of contagion. Now, we saw in 2008, what we saw in 2008 was when one big bank and a couple of others began to fail, and they couldn't pay their depositors. They could not pay up what they owed. They were closed. And the regulators, they had to move very quickly. And this is kind of when they came up with that term. You guys have heard it from back in 2008. If you're old enough to remember the 2008 recession, you remember the phrase "too big to fail." So that's where it came from. And, but we ended up with a huge financial crisis, because when one big bank starts tipping over, then other banks tend to follow suit. And it's a big house of cards problem. And we don't yet know if we're there or if there's going to be some contagion this time around. I certainly hope not. Now, what we do know is that this bank was obviously overextended, and this is related to the Fed. And as interest rates went up, this is not just affecting, consumers, this is affecting businesses, but it's also affecting banks, okay? And businesses' strength affect banks as well. And this is a great example of that, unfortunately. So as interest rates went up and the banks, were lending a lot of money to a lot of startups. Think about that, right? Think banks lending to startups. Startups have a fairly high percentage of failure. The failure rate for startup businesses is fairly high, right? And then all of a sudden, Fed Chair Jerome Powell starts jacking up interest rates. If you're lending out a lot of loans, these are high risk loans going to startup businesses, and these startup businesses end up starting up in a recession that likely increases their difficulty in survival. So a lot of these startup companies are having difficulty repaying the banks. And so now this creates a huge problem for the bank. Now, as interest rates went up and the banks were lending a lot of money to startups, it just simply couldn't handle it. So, in terms of economic news today, this is definitely the biggest news story out today. Now, they talked about the jobs number and how, the jobs report was a good signal. And this may point toward a soft landing, but this could change everything. But this particular bank implosion has the potential for contagion, which may very well reverse Fed Chair Jerome Powell's direction. Now, a lot of people were calling for a Fed pivot. Maybe this forces the Fed to pivot sooner than expected, because last time we heard from Fed Chair Jerome Powell, we're looking at somewhere between a 25 and 50 basis point rate hike at the next meeting. So this is definitely going to weigh heavily on them. I already know. So, it may lead to no increase at the March meeting, at the March Federal Reserve meeting. And in fact, it could even be conceivable that interest rates start dropping out of fear that we may be in more trouble than the Fed knows about. And let's talk about wages, right? So income, wages, according to Jerome Powell, wages that people are earning are pushing prices up. This is why the Fed is trying to push for all of these layoffs and all these millions of people need to lose their jobs. It's not the case, really, if you think about it. We're seeing the smallest wage increase in over a year. Prices continue to rise, but wages are not the cause for prices rising. Okay? I want to be very clear about that. Wages, the amount of money that people are making, it's not like people are balling out of control, and this is why prices keep going up, because people just have so much money. They're just spending money, and there's more money flying after goods, and the price of goods is going up as a result of people having too much money. That's not the case. Right? So what's pushing up many prices here in the United States is that big companies that want to increase their profit margins, and some of them have monopolies, they have near monopolies, they have oligopolies, and they're using this opportunity, blaming it on inflation as an excuse to raise their prices. Y'all know who I'm talking about. I don't care if you shop at Walmart, Target, Home Depot, Lowe's, wherever you shop, you're seeing price increases. Is it really because there's so many consumers out there with so much money that's driving up the prices? Or are these companies knowing that we can blame inflation on price increases, and they're leveraging this known monetary problem called inflation? They're leveraging this inflation to drive up their profits, and they're driving up their profits on the backs of Americans. And then the Fed is seeing this, and they're identifying this inflationary problem, and their only tool is to raise interest rates, which is not even fixing the problem, really, right? And who gets hurt first? Lower income Americans, middle class Americans. It just this problem works its way from the bottom up. So when there's problems, the problems always come from the bottom up. But when there's new money coming into play, it's always from the top down. So never forget how this is working, folks. Now, if we look at today's report, for example, we're seeing like the smallest wage increase in over a year, yet prices continue to rise. And so, if interest rate hikes are the only tool that the Fed has to try to bring down inflation back down to the 2% rate, that goal, then what else can they do to try to tame inflation? If not increase the interest rate, should the Fed just stop raising interest rates now, since things are beginning to show real signs of getting out of control? I think they need to strongly consider that. And, I don't want to predict where this could go, but I'll just leave it at that. But, as we know right now, inflation is slowly coming down. We're not seeing it at the retail level, but reports are showing that there's evidence that inflation is coming down to some extent. Now, I think, as the key here is the direction. Now, if inflation were increasing, that would be one thing. But inflation's actually starting to slow down. So if we're seeing it go down in the right direction, then it's not really clear that the Fed has to keep raising rates and continuously risking a recession that could ultimately hurt everybody.